We talk a lot about holistic financial planning, don't we? And I was thinking about holistic financial planning in the context of estate planning and the importance, I think, of taking account of all assets, all of your assets, when you're thinking about your plan for successful intergenerational transfer. It's easy, I think, because of the sector we're in, to over-concentrate on our purely financial assets, the cash and investments that we have. And of course, there's a lot we can do in relation to estate planning with those assets. But it's really also important to take account of all of our other assets in putting together a comprehensive slash holistic plan. So just quickly, cash and investments. Yeah, we can do a lot with those, especially to overcome one of the main objections to estate planning, in fact, two of them, the need for control and the need for potentially access. Both of those can be relatively easily overcome, and the anti-avoidance provisions that exist in relation to estate planning overcome with financial product and trust combinations. And let's not forget, by the way, that financial planning in relation to assets in the estate planning world is not confined solely to insurance-based assets. So then we move on to another main asset, pensions. Well, we don't need to worry about those, do we? Because they are free of inheritance tax, largely. And of course they are. But let's think a little bit more about when the assets leave the pension funds. Let's not forget that, where they go when they leave the pension funds, and thinking about maintaining their inheritance tax effectiveness beyond the pension fund, perhaps through an asset preservation trust, a spousal bypass trust, as they're sometimes also known. Think about that too. Next, your business. Don't need to worry about that either, do you? Because that qualifies for business relief in most cases, and yes, it does. You satisfy the conditions, it will qualify. But let's not forget about those underlying assets that may be treated as accepted assets. Cash that's not used for the purpose of the business, not used in the business, can proportionately deny you inheritance tax relief. But otherwise, the business, yeah, it's free of inheritance tax. But what about when the asset that you own is no longer the business? When you've sold the business, you need to think about planning beyond and planning ahead for that beyond. How about sale of the business on death? You've got your arrangements in place, but then your family owns cash, not business assets. Planning with trust to ensure that the family's wealth continues to be inheritance tax effective, another great area. And then, of course, your main residence. Well, you can't do much about that, can you? Because mostly you want to carry on living in it, and you don't want someone else living in it with you. And you probably don't want to pay a full market rent. So there's not much you can do during lifetime to give that residence away. Agreed. And post-death, you might have an idea that your family is going to inherit the family home, and of course they will, but they're very unlikely to come and live in it. There's more, usually, sometimes more than one person that's inheriting, and they don't want to come back and live together like they did when they were kids. So basically the house is probably going to be sold. And that's an area to sort of consider when planning with the main residence. Okay, you might not be giving the property away itself, but in some cases where you want to do something about inheritance tax and you're property rich, as it were, but have little in the way of other assets that you can or want to carry out planning with, then releasing that cash from the property by way of a lifetime mortgage might be worth considering. And I stress might be. You really need to do the numbers in each case, but just consider the principles. When you're in that situation, you want to make a lifetime gift. You haven't got the means to do it with your other assets because you really don't want to give up the liquidity, the access to the cash and investments, and you can't give a proportion of the house away effectively if you want to carry on living in it. Releasing some of the money by way of a lifetime mortgage, fixing the interest rate. The debt is effectively going to be inheritance tax deductible whilst your estate remains subject to inheritance tax. So you're effectively getting delayed tax relief on that debt and the accrued interest. Your lifestyle doesn't change. And you can use the money to make an immediate gift and satisfy that sort of emotional need or desire to actually see your kids get the benefit of the money rather than waiting until death. Now, you need to do the numbers and play that right the way through until the end with different assumptions to see if it makes sense overall. But it's something that's, all I'm saying is, worth at least giving some consideration to. And that's where the benefit of financial advice comes in, is helping the client to have that balanced consideration, but to not consider it at all in those circumstances would to be not holistic. So my end to this little rant, as it were, is to don't forget to consider all of your assets when thinking about estate planning. Be truly holistic.